Have you ever looked at your business's financials after, a really tough year, maybe a significant loss, and wondered, okay, how can I make this setback maybe work for me on my tax return? It's pretty natural thought, right? Finding every legitimate way to minimize what you owe, especially when the business is already, well, feeling the pinch. Today on the deep dives, we're going to unpack a critical, but yeah, often pretty complex area of tax law, the excess business loss limitation. EBLL for short. This isn't just about reciting a rule, it's really about digging into how the tax system tries to balance things, allowing legitimate business deductions, sure, but also preventing taxpayers from completely wiping out their non business income, things like your salary or commissions, using those big business losses. So, our mission today is to go beyond just the surface level. We want to grasp the core purpose behind EBLL, navigate its intricate application layers, and see exactly how it fits into that whole bigger picture of tax loss limitations. We'll use some clear, practical examples to bring it all to life. Help you see how this one rule can really change a taxpayer's bottom line and how it interacts with other tax concepts you might already be sort of familiar with. Okay, let's unpack this. But actually, before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, explanations, everything we discuss, it's derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, definitely visit the website. They've got additional practice questions, video lectures, detailed support to really reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, so let's start right at the beginning. What's the fundamental idea, the driving force behind this excess business loss limitation? Why does it even exist?
Yeah, that's really the perfect place to start. The main goal, the fundamental purpose of EBLL, is pretty direct. It's designed to put a cap on the amount of non-business income, like your salary, maybe consulting fees if you're self-employed, that can be, let's say, sheltered or reduced for tax purposes by really substantial business losses. You see, before this rule came along, a very large business loss could theoretically just completely eliminate all of a taxpayer's other income, potentially leading to zero tax liability for that year. So the government introduced EBLL to address what they saw as, well, an imbalance, to prevent that kind of complete income offset happening all in one go in a single year. The mechanics are like this. If a non-corporate taxpayer, so not a C Corp, has what's defined as an excess business loss, that specific excess part isn't allowed as a deduction, not in the current tax year anyway. Instead, it gets carried forward, becomes part of the taxpayer's net operating loss, or NOL carry forward. You can sort of think of an NOL as a bank of past business losses you can draw on later to reduce taxable income down the road. So the loss isn't gone forever, it's just deferred, pushed into a subsequent year.
Right. Deferred, not lost. That seems like a really crucial distinction for planning. And you said excess loss. Does that mean there's a specific number, like a threshold, that defines what counts as excess?
Absolutely. There are very clear threshold amounts. For example, if we look at the 2022 tax year, for a single taxpayer, that limit was $270,000.
Okay.
And for those married filing jointly, it was double that,
Yeah.
$540,000.
Gotcha.
And it's important to remember these numbers get adjusted each year for inflation, so they do creep up over time.
Yeah.
What's really interesting here, though, in kind of critical context, is that this rule is pretty new. It didn't always exist.
Oh, really?
Yeah, it actually came into effect with the 2017 Tax Cuts and Jobs Act, so during the Trump administration. Before that, non-corporate taxpayers, well, they had a lot more flexibility. They could deduct much larger business losses against their active income without this specific EBLL hurdle. So yeah, it was a pretty significant policy shift, really aimed at preventing perceived situations where maybe individuals were using large, sometimes, paper business losses to offset substantial earned income.
That is a profound change. It must have really redefined tax planning for a lot of people. Let's try to make this concrete. Can we walk through an example? Imagine, say, Adam. He's a single taxpayer, it's 2022, and he runs his own business. And let's say Adam is very involved, he materially participates, he's hands-on. In 2022, his business brought in $320,000 in gross income, but deductions were huge, $700,000. Maybe he bought and immediately expensed some major equipment. So that leaves Adam with a net business loss of $380,000. How does that $380,000 loss run up against the EBLL rule?
Okay, good example. So under the old rules, pre-TCJA, that entire $380,000 loss, it would have been fully deductible as an NOL against Adam's other income, assuming he had enough because he materially participated. It would have just directly reduced his taxable income. But now, with the excess business loss limitation firmly in place, Adam's immediate deduction is limited. Since Adam's single, and we're using 2022 numbers, he's capped. He can only deduct $270,000 of that loss in the current year.
Okay, so the immediate hit is a smaller deduction right now. What happens to the rest? That's what, $110,000? Is that just evaporated or does it still have value?
Oh, it absolutely still has value, and that's, like you said, key for planning. That remaining $110,000, the difference between the $380,000 total loss and the $270,000 he can deduct now it gets carried over. It becomes an NOL carry forward for future years. It's essentially a tax asset now, like a credit he can use to lower his taxable income in later years.
So the benefit is deferred, delayed, but not totally eliminated.
Exactly. And it also really highlights how critical filing status is. If Adam happened to be married filing jointly, remember, his 2022 threshold would be $540,000.
Right, much higher.
Yeah. So in that scenario, his $380,000 loss would actually be under the limit. The EBLL wouldn't even apply to him, and he could deduct the whole thing in the current year.
That simple example really does clarify the basic mechanics, but I sense there's more complexity coming because you mentioned this isn't the only rule that can limit deductions, right? It's like the last stop.
That's precisely it. This is where it gets really interesting and, frankly, where taxpayers can get tangled up. When you have a business loss, especially from a partnership or S-corp, there's a very specific sequence, a kind of hierarchy of limitations that your loss has to clear before EBLL even enters the conversation. Think of it like 4 gates, maybe 4 hurdles your loss has to pass through in order. First, you hit the tax basis limitation. Can't deduct more loss than your investment basis.
Okay, hurdle 1.
Second, the at-risk amount limitation. Generally, you can only deduct losses up to the amount you personally stand to lose, the amount you're at risk for.
Hurdle 2, got it.
Third, the passive activity loss, PL rule. If the loss is from a passive activity, you generally need passive income to deduct it against.
Okay, PL rules, hurdle 3.
And then, only then, if any loss amount has survived all those checks, does it finally face the 4th hurdle, the excess business loss limitation, EBL. You can only deduct the loss amount that makes it past all those prior gates.
Wow, okay, a 4-step gauntlet. Let's definitely use another example to see these layers interact. How about Alex? Let's say it's 20x3, and he has a significant passive business loss coming from an AB partnership. Alex's share of the ordinary loss from AB partnership is $26,400. And crucially, Alex is passive here. He's an investor, not actively running things. Now, Alex's tax basis in this partnership is $27,000, but his at-risk basis, only $21,000. That difference, often comes up with things like non-recourse loans where Alex isn't personally on the hook for that portion of the debt. And just to complete the picture, Alex also has $11,200 in passive income from other places, $5,200 from, say, an XYZ partnership, and $6,000 from some rental real estate. So how does Alex's $26,400 AB loss navigate these 4 hurdles?
Okay, perfect scenario to illustrate the sequence. Let's walk through it step by step. First hurdle, tax basis limitation. Alex has a tax basis of $27,000. His loss is $26,400. Since his basis is more than the loss, he clears this hurdle. No loss suspended here. He has enough basis.
Okay, gate 1 passed.
Gate 2, at-risk limitation. Now, Alex is only at risk for $21,000. This is where we see the first cut. Even though the loss share was $26,400, he can only potentially deduct up to his at-risk amount. So the potentially deductible loss is immediately trimmed down to $21,000. That means $5,400 is the loss. The difference between $26,400 and $21,000 is now suspended because of the at-risk rules. It hangs around waiting for his at-risk amount to increase, perhaps.
Right, so $5,400 is sidelined already. What's next?
Next, hurdle 3, passive activity loss, PAL limitation. The loss amount that made it past the at-risk rule is $21,000. But remember, this is a passive loss for Alex. To deduct passive losses, you generally need passive income. Alex has $11,200 of passive income from his other activities, XYZ and the rental.
Oh, okay.
So he can use $11,200 of his $21,000 allowable passive loss to offset that $11,200 of passive income. That leaves $9,700 of the loss, $21,000 minus the $11,200 he could use. This remaining $9,800 is now suspended under the PL rules. It gets carried forward to future years because he doesn't have any more passive income in this year to absorb it.
Okay, so another chunk, $9,800 is suspended, this time by PL rules. That leaves, well, nothing for the last hurdle.
Exactly. We finally reach hurdle 4, excess business loss limitation, EBLL. But in Alex's case here, the EBLL does not apply.
Why not?
Because the loss that even started this process was only $26,400. And certainly the amount deductible after PL, $11,200, or even the total suspended amount, $15,200, is way, way below the single taxpayer EBLL threshold of $270,000,
Hmm.
using our 2022 example. So while EBLL is the final gate, it only matters if the loss that survives the first three hurdles is still really substantial.
Okay, so connecting this back to the big picture, even with all those layers, Alex did get to deduct $11,200 of his loss this year. But yeah, a pretty significant chunk, $15,200 in total, $5,400 from at-risk, $9,800 from PL got suspended. Tied up for now. Which naturally leads to the next big question for anyone dealing with this stuff long term. What actually happens to those suspended losses? Do they just sit there forever? Or is there a way to eventually use them?
No, they definitely don't vanish. And that's a huge relief for taxpayers, honestly. There's a critical rule. When a taxpayer completely disposes of their entire interest in the activity, like selling their partnership interest or S-Corp stock, any previously suspended passive losses from that specific activity, whether they were hung up by at-risk or Patel rules, they essentially wake up.
Wake up?
Yeah, they become active. They're freed from the passive activity restrictions. This means they can finally be used, generally against any type of income.
Okay, so let's apply that back to Alex. Suppose in a later year, he sells his entire interest in that AB partnership. Let's say he has a capital gain of $25,000 from the sale. What happens with those suspended losses?
Right. So those $5,400 of at-risk suspended losses and the $9,800 of PLS suspended losses, that $15,200 total that was stuck. When he sells his interest, boom, they become active. Alex can now deduct that full $15,200 in freed up losses against other income. In this case, it's very handy. He can use it to offset his $25,000 capital gain from the sale, significantly cutting down the tax bite on that gain.
Oh, okay.
It's the tax system's way of finally allowing the deduction for those economic losses once the investment in that specific activity is totally finished.
That makes sense. A mechanism to eventually recognize the full economic loss. Okay, good to know they're not just lost in limbo. But now, let's really crank up the numbers. Let's imagine a scenario where the excess business loss limitation does become the main event, where it really flexes its muscles because the losses involved are huge. Let's modify Alex's situation again, dramatically. Suppose over the years he's accumulated a massive suspended PLL carryforward of $400,000 from this AB partnership, and in the year he finally sells his entire interest, he also happens to have $30,000 in passive income from that other XYZ partnership, plus $300,000 in wages from his job, and maybe, I don't know, $100,000 in gambling winnings just to make it interesting. How does this play out with EBLL?
Okay, yeah. This is where EBLL truly takes center stage. Let's walk through the steps again. First, Alex sells his AD partnership interest. That action triggers the release of the entire $400,000 cumulative suspended passive loss. It's now active, ready to be deducted.
Step 1, loss becomes active. Got it.
Step 2, use it against passive income first. Alex has $30,000 of passive income from XYZ, so he immediately uses $30,000 of his now $400,000 active loss to wipe out that passive income. That leaves him with $370,000, $400K, $30K of active loss, still available for deduction against other income.
Okay, $370,000 active loss remaining. Now what?
Now, step 3. This $370,000 active loss runs smack into the excess business loss limitation. Alex is single. Using our 2022 limit again, he's capped at deducting $270,000 of business loss against non-business income in the current year.
So even though he has $370,000 available, he can only use $270,000 right now.
Exactly. He applies that $270,000 limit against his other income. He has $300,000 in wages. So he uses the $270,000 loss to offset those wages. After applying the loss, only $30,000 of his wages remain subject to tax this year. The gambling winnings, by the way, are generally taxed separately and aren't typically offset by these kinds of business losses.
Wow. That $272K deduction makes a huge dent in his wages. But wait, there was still $100,000 of loss left over. $370K is available, $270K used. What happens to that? Is that lost?
Nope, not lost. That's step 4. The remaining $100,000, the amount that was limited by the EBLL this year, gets carried forward. It becomes a net operating loss, or NOL, carry forward. He can use that $100,000 NOL to reduce his taxable income in future years, whether that income is passive or active. Again, the benefit is deferred, not eliminated.
So thinking about the bigger implications here for Alex, this rule clearly changes the timing, doesn't it? It dictates how much immediate tax relief you get from a really big business loss, especially one released upon sale. Before this rule, Alex would likely use that whole $370,000 active loss in the year of sale, potentially wiping out his wages entirely and maybe other income too. But now it's sort of metered out, a phased approach.
Precisely. That's the core impact. It significantly curtails the ability to use massive business losses for aggressive short-term tax sheltering in the year the loss is realized or freed up. For taxpayers and planners, the big takeaway is that predictability and thinking across multiple years become even more critical. A huge loss today might not give you that immediate massive tax refund you might initially expect. Instead, it creates a potentially valuable long-term asset that NOL carry forward, but its ultimate value depends heavily on your future income situation. The loss isn't gone, but it's delayed. It requires a different kind of strategic outlook compared to the pre-2017 environment.
Wow, okay. That was quite the journey through the EBLL. We started by just defining it, saw it in a simple case with Adam, then really unpacked its place as that final hurdle after basis at risk and Papao rules with Alex's initial scenario. And finally, we saw its full power, its limiting effect, when dealing with those really substantial losses in the modified Alex example. It's definitely a complex but clearly vital piece of the tax puzzle.
It really is. The excess business loss limitation is a critical rule for non-corporate taxpayers. It's deliberately designed to strike that balance, allowing deductions for real economic losses, but preventing what Congress saw as excessive income sheltering all at once. And crucially, it never operates in isolation. It always works together with those other key limitations: tax basis, the at-risk rules, and the passive activity loss rules. Understanding that whole sequence, that hierarchy, is absolutely fundamental for effective tax compliance and strategic planning.
So thinking about all these intricate layers basis, at risk, PAL, and finally EBLL, and how they defer the benefit of losses. Maybe a final thought for you listening is this. What parts of your own financial life or business activities might touch on these rules? And how could understanding them better, knowing that a loss today might be structured as a valuable asset for tomorrow, help you plan more effectively for your financial future? We really hope this deep dive has left you feeling more informed and maybe a bit more confident the next time you encounter the complexities of business loss limitations.